Before we start this video, do like and subscribe to our channel and not miss on any updates.
Good morning, dear friends. ICAI, very probably just probably yesterday or so, has updated the CA final AFM study material. Now, are there many changes? Actually not. There are not many changes in the study material. In fact, there are 2 or 3 changes where they have actually synced their answers, or rather synced their solutions or workings or formulae to what I have been saying all along and what I have actually written to the institute also. Okay, so you please have a look. I'll highlight to you the broad changes. Now, there may be 1 or 2 small changes here and there which I might have missed. If I come to know of them in due course, I'll highlight. But I have gone through fairly quickly the entire study material, compared both the old and new study material side by side. So, for May 25, following are the changes. See, in financial policy and corporate strategy, the first chapter, they have added a question on external funds requirement. So, this is a first illustration that they have added. I'll actually show that to you as well. Right. Now, this particular illustration, illustration 1, what has been added is actually we have solved in my book P600 plus. This book in business valuation chapter I solved it, and it is illustration number 13 in business valuation chapter. Same, and it's actually a question from Jan 21 question paper. Okay, same question, they have multiplied all numbers by 10 and put it in the first chapter, financial policy and corporate strategy. I will show you that particular question also, and I actually disagreed with the solution that was given in the Jan 21 suggested answers, and I said that my solution is more reasonable, logical and correct, and exactly is what they have done even in their latest material. So, I will show you that. Please have a look, but first please see, these are the 4 or 5 chapters where changes are there. First one is financial policy, corporate strategy, one particular illustration that is changed. Advanced capital budgeting decisions, the first illustration, not the test your knowledge wala questions, but the first illustration what is there. A lot of students had been raising the issue, sir, how is this possible? And I had told them also at that particular point of time, I will show you that also, that the illustration is poorly framed and how you have to look at it, I have explained to them, they have made that particular change. Then there is this question on this concept on FCFF, FCFE, where they had given the formula incorrectly, where they had directly copy pasted some material from internet or some US author, where cash flow from operation to that they were making direct adjustment for interest. And I had written to Mr. Rajkumar Aduke also, saying that, sir, this is incorrect. In Indian context, cash flow from operations does not include interest. It is a financing activity, whereas in US case, interest expense is a part of cash flow from operations. So, they have made that change also in the part of the formula that they have explained. I will show you all of those. Fourth is the mutual funds chapter. They have removed one illustration, very basic illustration, nothing fancy. It's illustration number 10 of the old study material. And in the interest rate risk management chapter, they have, wherever I have been highlighting that they have been using LIBOR, they have changed it to SOFR. Okay, I have highlighted a lot of you that these market reference rates have changed, LIBOR is no longer in vogue and all of that in the IRRM chapter. Finally, they have made changes and they have removed wherever LIBOR reference was there, they have added SOFR reference. Okay, so these are the broad 5 changes, what I have been able to see. I'll probably spend some more time and see if there are, made some minor changes here or there or anything like that, because, it's a very vast syllabus, right? Fairly vast content or PDFs, and you have to go through manually. But on the face of it, these are the 5 things that appear. Now, I'll explain to you what are these 5 things also. Just hold on for a minute. So, friends, this is the first chapter, first question that they've added. This is that external funds requirement. In this chapter, whatever this Jan 21 question which I was highlighting earlier, same question I had given my own solution. You are here seeing the solution to question 13 in business valuation chapter. And I disagreed with Jan 21 solution of suggested answers of the ICAI. And if you look at the solution, now I'll not get into the entire question. The final solution, right, if you look at it, I said external funds required is 225, long-term loan increase is 80, then short-term loan there is no increase, and equity of 145.6. This is what I had written, and short-term loan 300, long-term loan 480, so on and so forth. So this is what I had given my solution. They have changed their suggested answer solution. They have come back to this. Let us see what they have given. So friends, now look at the solution what they have given. This is the only question they have added in this particular chapter, financial policy, corporate strategy. There is all the numbers, as I said, multiplied by 10, amount of external fund requirement, and you see here Amount to be raised from short term funds is nil. The balance is 540, what I was saying, they have put 5,400. Balance from external source 2256, I had 225.6. Then they said balance from new equity 1456, I had said for 145.6. So same question, what I have solved in the class is 100% right. Probably we'll have to shift from business valuation to financial policy and corporate strategy. That's all. This is the change in the first chapter, one illustration that has been added. Okay, now let us move to the next one. So friends, now this is first question, illustration 1 of advanced capital budgeting decision chapter. Now in this particular question, initially what was there? So initial outlay of the project is 40,000. They had actually given the life of the project and they had said compute depreciation. And then after computing depreciation, they wanted us to compute the real cash flow and nominal cash flow. I received multiple queries from students where they said, sir, will we have to adjust inflation aspect also on depreciation? Okay, I'll show you the, the questions that students asked me in our forums. I'll show you that. Though a lot of students had this out, and I particularly I told them, no boss, this particular question is poorly framed by ICAI. This is not a correct way of asking the question, right? So they have removed the entire depreciation angle in this question and directly have given what is the annual post-tax cash flow of the project. That way you don't have to do any adjustment for depreciation, you don't have to do any inflation tax and all of that for depreciation. Okay, so let us have a look at the question in the old syllabus. In the old syllabus, or in the previous, before May 25, they had given initial outlay of the project, they had given annual revenues, depreciation, useful life, salvage value, tax rate. Now they have not given that. So what was happening was, when you had to compute the nominal cash flows of every year, people were taking revenue also inflation, then costs also inflation, but should we inflate the depreciation, yes or no? Okay, whereas I had told that, boss, aisa mat karo, don't do that. Directly take the real cash flow number of the first year and directly apply inflation on that. Okay, so now they have changed the question itself so that there is no depreciation ka problem, no inflation ka problem on depreciation. Okay, this is the question in the old material. And if you look at the questions that my students have asked me, right? So, sir, in this problem, why are we multiplying real cash flow with inflation to find out the nominal cash flow, and why are we not directly multiplying? When was this asked? This was asked in March 24. Okay, then I said, I had given a response to that. Then you look at the next question. This was again asked in March 24. The assumption here is on net CFAT. The inflation rate is only on the net CFAT, not individual item 11. It is a poorly framed question by ICAI. In real world, we don't solve like this. I had given an answer then itself. So there's a bunch of students who had asked me this question. So, and I had told them that this is a poor way of framing the question, and ICAI has actually corrected them. So good ICAI, you have corrected, you have made a change. Okay. So friends, this is in security evaluation where they have added a small line here, star. This is page number 5.12. As per US GAAP, if interest has already been adjusted in CFO, then interest will not be added again. What does this mean? They have added this one small line somewhere. Okay, what is the correction, how, what, where, you may or may not understand. So I'll show you the actual email that I had sent to the institute because, in order for them to add this. And this is pertinent to this here in this particular point, that is the last, based on cash flows, CFO. This is where they had to make an adjustment. What is the adjustment? Let us discuss. So I sent a mail to Rajkumar Advikya sir. I sent it on 17th of July, where I had specifically said, sir, I wish to highlight an error in page 5.11 and based on cash flows. So I had actually shared the screenshot also. Said, sir, FCFF computation with starting point as cash flow from operations. I wish to highlight that formula is directly taken of US authors. Therefore, FCFF is I've given a bunch of stuff. Okay, so what basically I said is, hence the correct formula we should be showing in our books is this and not what is given in point E in ICAI material. So they have actually pointed out that if cash flow from operations include interest, then required adjustment has to be done. So this is the correct formula that you should have for FCFF when you are computing FCFF from cash flow from operations, especially in Indian context where interest expenditure is a financing activity and it is not included in cash flow from operations. So then you adjust, or rather in FCFF you subtract only the tax benefit of the interest. So when you look at the next change, it is in mutual fund chapter. They have deleted this illustration number 10. I don't know why they have deleted it. I'm not aware. I'm at least not aware why they wanted to delete. Probably it got anything to do with days, I don't know. But I'm not really sure why they choose to delete this illustration. But anyway, it's a good quality illustration only. Okay, fair enough. This is fourth change, and let us come to the last change, which is interest rate risk management chapter. In that, I need not show you anything also because wherever LIBOR reference was there, that they've changed it to SOFR reference. That's all. Okay, so this is the summary of changes. So guys, please do like, share, subscribe our channel. Please keep following me. I give a lot of these kind of updates on AFM in my channel. So please do refer us to your friends, and if you're looking to enroll, please reach out to us at the number given below, and we are more than happy to assist you in all your CA final preparations. All the very best.